Let's start off with something very simple. What are the new trading hours now?
Well, we've extended our hours to 8 a.m. Hong Kong time.
Okay.
So it allows Asian investors to tap our markets early now. We did extend our hours back in 2018 to European trading open, so which was roughly 2 p.m. Hong Kong time.
Yeah, is that a good benchmark, how Europe has done in terms of what type of flows you're going to get from this part of the world? What are your expectations now when it comes to flows?
Absolutely. When we extended our hours into Europe, we noticed that a lot of the trading took place right at the open. So, clearly there were flows coming from Asia to begin with. But you look at the last year of what has been going on in Asia, we've seen net flows into Canadian fixed income, massive flows from both Japan and Australia. So this is the right time for us to be opening Asia hours.
And the products on offer right now?
It's going to be our headline derivatives. So,
okay.
From the Montreal Exchange, it's our bond derivatives, our, our 2-year, 5-year, and 10-year bond futures, as well as our STIR, which is our BAX and CORA futures, and then the headline TSX index futures.
What do you think is the appeal then for Canadian derivatives? Because, I mean, the Canadian market is smaller, it's shallower than US and Europe. This could be an uphill battle for you. What are you doing to entice global investors to the Canadian market?
Well, I think we're pretty fortunate. I don't think we really need to do much enticing. I mean, Canada being a very stable economy, we do already make up quite a percentage of global bond markets, a little over 3%. You look at the types of flows that are already going into places like Australia, we're not dissimilar. What's great for us is that, this is a convergence of 3 different factors that we see. One is, internally at TMX, we want to bring Canadian markets to global investors. 2 is that, we're making a big push to be closer to our clients, listen to what their needs are, and meet those needs. And third, it's what's going on in global markets. We're seeing globalization of investment portfors, and particularly around the region with the Asian pension funds, sovereign wealth funds, and so on. So it's those 3 factors that really make our push into this region a big.
Well, I mean, that being said, it's probably a little bit of both, but are you targeting more sell side or buy side? And in terms of the value proposition that you guys bring, what do you offer for both, essentially, is what I'm trying to get to? It
really is both because, from the sell side perspective, even from my own past career, historically when sell side banks saw flows into Canadian cash bonds, there was no good way of hedging those flows. Historically, sell-side banks used, U.S. Treasury futures, for instance.
It's not perfect, though.
Correct, and then had to unwind those trades during North America Open. With us opening in Asia, that alleviates that issue of hedging requirements. But from a buy-side perspective, real money flows, it allows you opportunities both for hedging, but as well as risk-taking. Event risk is a major issue, and we're pretty fortunate with the timing of all this, right? The Canadian government has gifted us an event risk tonight in North America with the election results. So our Asian So our Asian investors will be able to tap that event risk tomorrow morning when results are flowing in. But then lastly, it's relative value trading. I mean, for the first time, our derivatives will be available to investors who are looking at the JGB market or the Australian fixed income market. And so as a result, they have the opportunity to look at relative values across the curve along with the Canadian market.